Hey everybody, welcome back. So today I'm going to be talking about a couple different options you can do to grow a small portfolio. And I'm going to be using very specific strategies with very low risk with a very high upside. Yeah, and if you like this content, make sure you smash that like button, subscribe, comment below if you have any questions or have any ideas you would like to discuss. I'm always happy to exchange different ideas. Okay, so without further ado, we're going to take a look at Cigna, Cigna Corporation. And for this strategy, we want to find stocks that are pretty much trading pretty flat. So that means it's very not volatile. Okay, so companies like Tesla, Lucid, those kind of companies, you do not want to trade this strategy on just because the volatility is pretty high. So volatile just means how quickly it can change. Okay, so you want to find a company that trades pretty flat, which just means that it trades pretty much around the same price. Okay, so I picked out Cigna, but of course you can do your own research. You can try and figure out your own the stocks that you think is trading flat. Cigna, in my opinion, has been trading pretty flat in the last couple months, and so that's why I'm using this as an example. Whenever you look at stocks, you can use a free stock screener just on Yahoo Finance. And yeah, so over here on Cigna, if you take a look at the moving average, I'm under Yahoo Finance. I'm looking at the Bollinger Bands. For the most part, as you can see, it's been pretty much, this is the last month. Okay, so it's pretty much pretty consistent. If you look at even the year to date, it's been more or less pretty consistent. Okay, so going to Robinhood, I'm going to show you what the strategy looks like. And the first strategy is a more common strategy. It is just the short iron Condor. So I'm going to show you what that looks like. So you go into Robinhood, you would trade options, and you're going to start by selling a put credit spread. Okay, and for these strategies, I would recommend actually just a week out, just not too far out, because in this case, in this scenario, time decay really is really on your side. So you want the shortest amount of time for the option to expire, and that way you can collect your profits. Okay, so we're going to go ahead and sell a put credit spread, which just means that you first buy a put and then you sell a put at a higher strike price. Okay, so over here, normally the way this works is if the stock doesn't go down by over 1.86%, then you would make a profit. But in this case, we're also going to do on the upside. Okay, we're going to do a call credit spread, which just basically means that you do the opposite, and you go ahead and buy a call. Okay, and you want to always move your strike prices the same number of deviations up. Okay, so the same number of strikes up. So meaning that before I sold and bought the strike price of the puts 2 and 3 below the share price. Okay, now I'm going to go up and I'm going to do 2 and 3 above the strike price. Okay, so I'm going to buy the call and I'm going to sell the call at the strike price underneath. Okay, and normally when you do that, you should see this little plateau. Okay, and basically what this means is, in order for you to profit, your stock would have to just basically stay within this range. Okay, so Cigna cannot move down over 2%. And it cannot go up over 2.64%. So long as you stay between the 2%, either up or down range, you're gonna max your profit at $138. Okay, and you're gonna do your max loss if it goes above or below that percentage is gonna be $112. So you're risking $112 to make $138, which is pretty good, in my opinion, for the amount of risk, especially if you find a pretty low volatile stock. Okay, so that's the first strategy, the short Iron Condor. The next strategy is a little more, it's a little more unorthodox, but at the same time, your upside is going to be a lot bigger. Okay, so I'm going to show you what it looks like. We're going to do all call options, and we're going to set the expiration still the same. And so first, we're going to sell a call option at one strike underneath the current share price. And then we're going to buy a call option above that share price, above that strike price that we sold the call option on. And then we're going to buy another call option below the share price that we sold that call option on. Okay, now we're going to do custom, and we're going to set this to a custom ratio so that we can sell 2 contracts of that same call option. Okay, so we should receive a credit. Okay, now if you take a look at this, now if you take a look at the chart, our max upside is $237, whereas our max loss is only $13. So we're risking $13 to make $237 on a stock that is relatively low volatile. Okay, so has low volatility. Okay, and basically what this means is the stock can go down by 1.46%, but it cannot go up by more than basically 0.76%. Okay, so if the stock moves up a little too much, then we start to lose money. Okay, but the loss is $13, and you can kind of adjust this around a little bit. Let me just kind of show you what it would look like if you adjust a little bit. So you can also sell the call option at the same strike price. You can buy a call option 2 strikes higher and 2 strikes lower. You just have to make sure that you end up getting a credit. So I'm not sure if this actually will allow you to receive credit. I don't think it will. Yeah, it won't. So you just have to make sure that you end up receiving credit. But if you can move, you can move this higher. Okay, so you can move this over here if you think the stock is going to be bullish, and then you can go ahead and buy your call options, and then you can custom set to where you sell 2 of your call options. Okay, so if you're bullish on the stock, that means you have more room for a signal to go up instead of down. Okay, and now your max profit is $192, whereas your max loss is only $58. Okay, this is a great strategy to do if you have a small portfolio and you're trying to build up your portfolio. You want to take a look at moving averages. You normally want to do this just really as short time as possible, so time is not really in your favor. But yeah, try this out with different companies that you think is just trading really flat. If you find a company that happens to be really, really flat, then this will be a really good strategy to trade these strategies on. Again, if you like this content, smash the like button and subscribe. Until next time, guys, I'll see you then.